I just wanted to do a quick introduction for Craig. Craig is the Chief Strategy Officer at Citra Living Lloyds Banking Group. And you may be thinking, well, Citra Living isn't actually about finance predominantly. But the reason we wanted to have Craig speak to this theme is precisely because Lloyds, as a massive financial institution, has taken the very far-sighted decision to set up Citra, and we're really looking forward to hearing more about that initiative. And so my question is, well, how can we encourage more financial institutions to put their money to good work in addressing this problem? So over to you, Craig. And this is just, you just do the green one.
Perfect. Thank you very much. Yeah, good afternoon, everyone. I was here this morning and really enjoyed the sessions and listening in to the conversations first part of the day. It did make me wince a little bit, though, because in my slides later on I talk about Barratts and house builders in a more positive way than potentially was portrayed in the room this morning. But we shall come to that. So thank you for the introduction. As was said, in terms of why we're here today, what Citra is all about, I think it is timely, it is definitely of the moment, and also, I think to be candid about it, it's also from our Lloyds perspective, a lot of the things we're doing now, we're kind of doing as a pilot, and we're trying to prove to people actually it can be done. We're taking some lessons learnt, sharing them with the wider market, actually trying to encourage more people into the space, whether it's PRS, whether it's shared ownership, wherever it may be. Actually, that's a big part of what we're trying to do in the bank in terms of that thought leadership and demonstrating it can be done, which takes us back probably 3 years ago, so prior to me joining Lloyds. Lloyds recognised actually from a kind of market ecosystem, housing ecosystem, it basically touched every sector, so from funding the developers big and small, from working with housing associations, obviously through mortgages within Halifax, even Scottish Widows, Lex Auto Lease. You can imagine the kind of breadth within the group, but also it has Birmingham Midshires, which is the private landlord mortgage company. But actually, it didn't do anything for renters. And actually, 3 years ago, Lloyds recognised actually there's a big and growing sector of the market. So that's where Citra came from. Here we are, 2 years on. These are kind of our kind of mission statements and kind of visions, really, in terms of genuinely, we're trying to do this in terms of the Lloyds footprint, which is across all of Britain. Hence, they're kind of here for Britain's renters. And this, again, this point of difference really around actually this point about putting down your roots, being invested in a place, being invested in the community, and actually we have a long-term approach to our kind of the homes and the places where we're working, and actually we want people to take the opportunity, because the stats are there, and I'm sure you've heard them all around actually the difference it makes to education, the difference it makes to jobs, employment, welfare, well-being, mental health, around having that secure home, and actually that peace of mind is really, really key for us in terms of actually we want you to feel like it's your home, we want you to stay there as long as you want to. But we can't do it ourselves, and this is where I guess the partnership thing comes into in a second in terms of actually we're working with house builders to provide these homes. So these are private rented homes to start with, and that's why from our perspective, this point about putting our customers first and then working with partnerships to do more collectively. I'm not sure if you can see this at the back, but this is basically our journey to date. So as I say, Citra started April 21, and going back to that kind of test and learn point I made earlier, actually, first off the blocks, just needed to find something. Actually, can they set up the business? Can they provide a service? Can they actually do this and stand up and demonstrate to the business and the wider bank that actually we can make this work? So actually, when I joined pretty much 2 years ago, October 21, it was just when we had the first customers moved in. We had a block of flats near Morph and Peterborough, which is 49 homes, and that was it. Lloyds bought it off a developer. It's part of a wider scheme, so affordable private end block, doing it all for private rent, just to see if we could make it work. So I say we had our first customers moved in October that year. You fast forward, I guess, to bringing us locally now in terms of where we are today. Last year we did our first deal with Barratts, and that's probably the first of many times I'm now going to say the B word, so forgive me. In Yate, so not too far from here, and that's why I kind of brought it to the example here today. Barratt's kind of doing their conventional house builder model, delivering the affordable different private sale, and actually us coming along from a funding perspective doing private rent, actually from a sustainability point of view, from the community point of view, and from a place point of view, there's an absolute value in providing different tenures. So rather than just having the binary private sale and affordable, actually providing some much needed private rent as well. Where we are now on that particular scheme, I think we're up to just over 100 homes already in management. So we're starting to really embed our ethos in this part of the world. Moving on to January this year, so we've basically got our private rent offer in place, which is great. So customers are paying market rent, and from a Lloyds perspective, that's one positive. But actually the bigger challenge for us, and then the bigger challenge in terms of like the societal side of things, okay, for those renters, and I said earlier, that's a positive choice. People are renting not by default because actually they want to as well. But for those people that actually now want to get into home ownership, what more can we do? So early part of this year, we launched an initiative called Pathways, which I can come back to later on, where basically we're saying to people, you're renting from us, when you're ready, and if you want to, you can now start to buy that home through shared ownership. So that's not doing it through a housing association, it's not doing it through grant funding, it's actually doing it privately. So again, this is about Lloyds demonstrating what can be done, we can prove it can work, and then hopefully others can follow in our place. So where we are today, so from 49 homes 2 years ago, we now have 700 homes in management, about another 300 to come over by the end of this calendar year, and about another 2,500 homes in the pipeline. And the point here, I guess, from a Citra perspective and a Lloyds perspective, we want to be close to our customers. We're doing this for the right reasons and for the long term. So actually knowing our customers, knowing the homes, being in control of our data and information is really key for us. So our approach on the management side is effectively a hub and spoke model. So in this part of the world, we've just got our first scheme in Cardiff coming through. We've got another 700 homes in kind of Bristol, the wider southwest, and actually that becomes a region for us. So we'll have dedicated on-site staff, we'll have dedicated offices that actually can know the customers and be close to those customers. And that's really important for us and for Lloyds as well. And then the idea there is that we then effectively replicate that through the country. So say first scheme in Wales, and actually we've got our first scheme in Scotland now. So again, that was mentioned earlier in terms of rent control. So I can come back to that at the end if useful. So you may look at this slide and see the slide earlier in terms of what the house builders are doing in terms of the quality of the homes. Point being here, as I said, this is in terms of the deep dive, what we're doing at Ladengana Village. So say, we will own ultimately 200 homes there, so it's a much, much bigger scheme. So there's 2,500 homes coming, affordable housing, private sale, and PRS now through us. Interestingly, and probably not surprisingly, of those first 100 homes, we've probably got 95% of people are moving there within the wider Bristol area. We are seeing some people moving in from overseas for employment or relocating, which is quite interesting. But our lens here in terms of how we look at our sites and opportunities is that we want people to sustain their tenancy. There's no point in us charging rents that are unaffordable. So actually in Ladengana Village, affordability is assessed on 30% of income, and all of our customers that are living there are well below that metric. So I think the average rent for us, it depends, we do a range of 1 beds all the way through to 4 beds. Average rent is about £1,200 a month. But I say that breaks back to 30% of income in terms of affordability. And in terms of the wider kind of, I guess, the market where the house builders are, and I say, it feels like there's not much sympathy for the big PLCs, the big house builders in the room. But I think what we are seeing around the country on the sites that we are now forward funding for private rent is that we speak to the subcontractors and the developers on site, and frankly they are now saying to us, actually if it wasn't for us forward funding these schemes, those sites would have stopped. Those suppliers wouldn't have homes to kind of work on and fund themselves. A reflection of the market where the house builders are in terms of the sales activity at the moment. So again, something for us to reflect on in terms of how can we as Lloyds support house builders across the spectrums, not just the PLCs, but the SMEs as well. How can we support all developers do more at this time? Pathways I mentioned just a second ago. So this is actually a scheme up in Chesterfield with Keepmoat, so another obviously big house builder. And just to kind of recap really in terms of what we were saying in terms of the offer. So in the absence of help to buy, understanding in terms of where affordability and constraints are from a kind of personal income perspective, there's a huge sector out there in terms of people that would potentially have bought previously through Help to Buy, or those people that wouldn't necessarily qualify for affordable housing in the conventional way. So as I said earlier, our starting position is still market rent, but actually when customers move in after a minimum period of 3 months, and they say genuinely when they want to, there's no requirement for them to do so, they can stay renting as long as they want to, but basically giving people the opportunity to buy that home on a shared ownership basis. As I say, it's not through grant funding, and it's not through a housing association. And actually, within the wider Lloyds ecosystem, obviously having Halifax is a big help. Halifax can provide the mortgages here. We want to be able to expand that offer further, so actually customers can go to whoever they want to get the mortgage. It's something we're looking into now. But what's really interesting here is that actually this offer, and it's only a small pilot scheme, so we have about 100 homes at the moment that we're looking at for the first phase. This isn't the first-time buyer product anymore. We're actually seeing lots of people downsizing, so talk earlier around kind of like the elderly spectrum in terms of where they're going to move to, what will they do, how do you free up existing homes. So we're already seeing that in terms of people relocating, downsizing. We're seeing people relocating, and we're also seeing, divorcees, splitters, whatever it may be, in later life. Actually, this is really powerful for them as well. They may have a small amount of money from the family home that was sold, but actually their income doesn't mean they can get a conventional mortgage. So we're seeing a lot of interest in this space. But let's say at the moment for us, it's just one pilot. We want to prove it can work. We think it will, and we think there's a good demand for it. And then scale it. And as I said earlier, this is our mantra really. Let's do it. Let's test it. Lloyds is big enough and ugly enough to do this and to learn the lessons on it. But when we kind of refined it, how do we take it to the market? How do other people to do more of this? So actually Halifax are really open-minded in terms of other people they're speaking to, other suppliers who maybe wanted to do something similar to us. And that's absolutely welcome because we need more of all housing types. So that's it in terms of Citra. We can come back to questions on that if you have time towards the end. But also I wanted to talk about Lloyds more widely and its ambitions with crisis. You may have seen in April this year, our respective chief execs made a call for 1 million new social and genuinely affordable homes. Big statement, big ambition. That's not to say that it's Lloyds going to find a way of delivering those homes. It's conversations like today. How can we basically get people together? How can we join the dots to do more housing of all tenures in all places? And actually, we're talking to quite a few regional cities. So Bristol is one of them. Really engaged, really exciting in terms of, again, what would Lloyd's role be with Bristol in terms of actually aggregation of smaller sites, bringing in SMEs, talking earlier around some of the pain points in terms of planning. But actually, if you're an SME, where do you find the £500,000 where it's going to take you and the 18 months to go take it through planning? Again, that's something that I think Lloyds is facing into in terms of actually, is there a role for us and a funding solution to help some of that stuff happen? So say we've got Bristol, Leeds, Birmingham, having conversations with them, the house builders, people at L&G, pension funds, the wide spectrum, Homes England, NatFed, basically having the same conversation, same challenges. So we're basically challenging ourselves, what are those radical solutions that we need as a country to do more? So absolutely open ears in terms of other ideas, other things that people might be working on that actually go, where's the gap? Is there a funding solution needed? Is there a housing association that's needed? What would it be? What would it take to unlock new developments? So for us, we're kind of, across Lloyds, looking at probably 3 main areas. It's all to be worked through in very, very early stages. Like I say, this was only kind of announced in April. So working with housing associations, and again, without generalising too much, lots of housing associations are doing less when it comes to development, given their existing challenges when it comes to fire safety, decent home standards, damp and mould, whatever it may be. So is there a way that we can help housing associations deal with that? How does that free up capacity to do more development? Is there a different way we can fund development off of their balance sheets to, again, free them up from a resource capacity to do more? How do we work with those regional cities? And fundamentally, how do we tackle the temporary housing crisis? How do we build more homes of all tenures and all types? So, yeah, like I said, genuinely really interesting in the conversations this morning. So that point about whether it's community land trusts or local authority land, whatever you can do to put in to make that impetus work and grow, how do we then make that scalable and replicable? And that's the challenge, because it's fine doing the kind of one-offs, but absolutely we need to make that something that we can then, that's the stamp, it works. This is the land, this is the developer, this is the manager, this is the funder. How do we do that and stamp that and make a real difference? So really exciting times within Lloyds. And again, just a bit of a personal reflection on my side. So I've been at Citra Lloyds for 2 years. Prior to that, I was in housing associations for 25 plus. And actually, I was slightly nervous when I came across, and maybe I'm still in the honeymoon period, I don't know. But for two years in, genuinely, Lloyds are doing this with a real purpose behind it. So yeah, there's a commercial angle, but there's a real purpose angle to it as well. And those two things, yin and yang, they do coalesce really well. But it's kind of profit for purpose. And actually, that's the point now for Lloyds in this kind of conversation around what more can we do. And actually, from a customer perspective, again, given that Lloyds is regulated, that kind of regulation comes through to us from a housing management perspective. So actually, we are, in terms of fair customer outcomes, that is laced to our business. So actually, when we're having conversations with customers in financial difficulty, if we're having a conversation around actually they can't sustain their tenancy, we are taking that genuine approach in terms of what is the fair customer outcome? How can we work with people? What can we do in terms of payment plans? How do we get people to sustain their tenancies? And for me, that's really, really refreshing, really assuring, because actually, having come from the social housing sector, for me, that really resonates and is really powerful. So I'm getting a 5-minute board being flashed up, so probably a good time to stop for questions. So either on the Citra side, in terms of the private rent and our shared ownership initiative, or on the wider Lloyds ambitions and kind of radical ideas that we can replicate.
Hi, really encouraging to hear. Can I ask, in terms of Citra, just so I understand, and sorry if you said this, are you a developer in that? Are you an RP, or are you coming alongside those? You're taking the homes that have already been developed, and if so, how many of those are, when you say affordable, we all know that's a tricky term,
yeah.
How many of them are social rent homes?
Yeah, no, it's a good point of clarification. I probably wasn't clear at the beginning. So no, we are just doing private rent, and we are effectively forward funding the house builders. So if we take Barratt's at Ladengardner Village, the first phase of 50, Barratt still build those, but effectively we are paying Barratt's to build them for us, and on completion we let them privately as the landlord. So we have affordability metric with a smaller A as opposed to a big A. So our point is more around when we're looking at the opportunity, looking at incomes in those locations, looking at demographics in those locations. Is there a depth of market that can sustain their tenancy, spending no more than 30% of their income on the rent? And that's a really strong metric for us. So at Ladengardner Village, that's absolutely the case, and that's fine. So we're not necessarily into 99th percentile of income. That's not what our offer is, as is the kind of mid-market, mass market, hence why we're kind of all points of the compass. Although interestingly and deliberately, we haven't done London, because affordability is more constrained, or depending where you look at it, in London than elsewhere. So for us now, it's private homes, open market rent. So we don't bleed into social housing, Section 106, affordable housing.
Thank you.
And just following on from that, when Barratt's give you these homes, sell you these homes, are you pushing them to go beyond building regs, or are you just accepting the bog standard?
Yeah, it's a great question. That's why you saw me grin when you started answering it, because in reality, today, it's the bog standard house. When I say bog standard, it's basically the developer's home. So we kind of recognise that in setting this up, the nature of the period it takes from planning through to build, as a new business, we couldn't necessarily determine our design from planning stage, wait 2-3 years to get the homes on balance sheet. So we always recognise there is this window at the beginning where we're setting ourselves up, where we'll basically be buying homes that have already gone through the system. And we kind of position that as effectively we're a market taker at this point. But so we're 2 years in now, we're 1,000 homes by the end of this year, growing pipeline, 2,500 homes already contracted. And using Barratt's as the example, we're committing to doing 1,000 homes a year with them, which is great in terms of how we can grow. But there's a point in time, which is now, where we actually say, just doing the same old isn't good enough. And also this applies, I guess, from a wider Lloyds perspective as well, in terms of actually Lloyds sponsors Next Gen, which is an ESG benchmark, in terms of actually what more can we now do collectively to encourage the house builders to do more. So actually, that conversation is happening with Barratt's in terms of the next phases we're looking at, what can we do in terms of those ESG credentials. But actually recognising that on the same scheme at LGV, so Ladengardner Village, we are doing a pilot with Octopus, details yet to be confirmed in terms of how it's going to work. But the idea where actually, what more can we do, whether it's PVs, air source heat pumps, batteries, to make those homes zero bills from the customer perspective. So again, to the point around starting these pilots, what can we do? What learning can we take? How do you justify the capital expense? What's the payback? How does it work from the customer perspective? So we're doing those now. And again, it's the same across the group. So we're doing a similar thing with Leeds City Council, through the main bank with the local authority, similarly with existing stock. What can we do? What's the whole house solution in terms of retrofitting, including, insulation, windows, as well as the kind of M&E type stuff as well. So lots of learning going on, but we kind of haven't really got the conclusion to it yet. But you're absolutely right. In terms of where we go in the future, actually we're now pushing the developers, can you get to Future Home Standard now? Can we push to zero carbon now? What is it we can do with Octopus around zero bills? Because it's not going to be good enough just to keep doing the same old for the next few thousand homes. But it's that point of time where we've gone from market taker today setting out to market influencer, and that's where we're at.
It's just a quick one. I just wondered what you offer in terms of your tenancy agreements. One of the discussions earlier in the day was about the fact that sometimes people, when they're in rented, they feel less secure. And my thoughts about that was, if you want a 6-month short tenancy, do you feel like it's your home? What sort of tenancy agreements do you offer your
so it's
residents?
an AST, but it's actually 3 years with 6-month breaks. So the flexibility works both ways. So if some customers are quite happy staying for 6 months, a year. I said earlier, generally we want people to sustain their tenancies. So the longer they stay, the more secure they feel in their home. It's better for them, better for us.
I just wondered with the shared ownership, what happens? Often people use that as a stepping stone to buy their second home somewhere else outright. What happens with those properties? Do you buy them off them and put them back into your pool, or are they sold on the market?
No. So for our model, not dissimilar to the housing association model, pretty much the only prerequisite when people move in is that they don't already own a home. So actually, if I use the example of maybe the divorcees, they have sold a family home. At the point they move into us, they don't actually own the home. They're moving from ownership into renting, which is kind of fine. So there's no kind of reverse, buying their property back. I think what's interesting is looking forward is actually when those customers that have moved into our houses have bought the home through shared ownership and they want to exit, actually we want the right to buy the home back from them to then put back into the market either as private rent or to put back as shared ownership, as opposed to just going to private sale. So again, very, very early days, but that's the kind of ethos about what we're trying to do. It's that flexibility both ways, really.
I'll ask a quick question and then give it back to the floor. We know you, Craig, and we know the plan, and we've been speaking for about a year. And effectively, your entry into the market is a big step entry with, as you describe it, a balance sheet requirement to get that business rolling. We're not anti the volume house builders, but their model might not deliver all the outcomes that the room may seek to get. But my understanding is, as you build that balance sheet up, the granularity of the projects you can start looking at can become a move towards the more radical. And and your model is a rental model, and in the co-housing world, lending to co-housing by the actuaries in banks is a safer lend because they're aggregating the link, the risk. Now, you're not a lender to build yet,
no,
and it's a big PRS move. So in terms of the flexibility around the granularity, once the boss is back at Lloyds Centre, again, this is working good. What's the appetite to go radical on some projects?
Great question. It depends how you define radical. So I think for me, the simpler answer is actually radical is actually taking some steps back earlier into the system. So like I say, to your point, we are coming at the end. We're funding schemes that have already been designed. For combinations of reasons, I'm absolutely obsessed with us getting involved early. We can really determine what a Citra home, a PRS home looks like. We can get involved from the design stages. Obviously, speaking with Guy as well in terms of actually making sure that's accessible in the widest sense of the term. So actually, the appetite in terms of risk, at the moment where Citra sits, something has to have planning, has to be involved with it. But that's as you saw the slide earlier in today, that's the tip of the iceberg at the end, when all the kind of the planning, the design, the input, the difference has been made. So we want to get involved earlier, for sure. I think then for us, Citra as it stands today, I think definitely bold and radical was probably more in the shared ownership space. So again, very much infancy in terms of what we are doing there with our first pilot, but I generally see that being something we can open up in terms of other ideas and other opportunities. But equally, and again, there's roles for everyone here. So for us, having stood the business up, largely by leaning on the PLCs to give us the stock and the comfort that Lloyds takes from working with the PLCs. The next level is actually how do we work with those SMEs? How do we work with the likes of yourselves in terms of actually doing something that is different and innovative, but actually makes a massive difference? So yeah, we're not necessarily there yet, but that's definitely in scope in terms of actually that next step forward. What is that radical response? But I would absolutely, from this take away though, hopefully the Citra thing is interesting, but there's a much bigger, wider Lloyds opportunity, I would suggest, in terms of where we are at the moment with crisis, with the ambition to think radically, to do stuff differently. So actually, it may not be Citra that could fund an SME developer today, but certainly within the group, there's other bits of the business that could. We have housing growth partnerships, previously worked with Homes England. So there's loads of stuff that we can do across the group. But like I say, generally, that door is open, the opportunity is there.
Great. Other questions?
Yeah, hi. My name's Alex Brooks. Can I ask a question about risk weighting in the assets that you're generating for Lloyds?
Yep.
Are you at a stage yet where you can where you're having to have a conversation around that, or are you adding a sort of Citra wrapper that allows these to be treated as regular loans, or sort of how does that work?
Pass in terms of the detailed response, because I said earlier, I'm not necessarily a funder per se, I'm more development. But in terms of what I understand from the kind of the risk lens, effectively we are a separate business to Lloyds in terms of funding. So we don't necessarily, it's not double jeopardy if we're doing a deal with Barratt's and Lloyds are funding Barratt's. Those two things are separate. So it's more for us in isolation where our exposure sits. We have other fun stuff we have to contend with in terms of just being part of the bank, in terms of, and again, without getting into the detail on it, things that we have to make sure we have in place in our partners, which is why, like I said, at the moment, it's easier for us to work with the PLCs and the bigger balance sheet developers. But again, that's purely about us starting. So, we'll soon be at scale. We've kind of proven to business we can make it work. So actually, we're fairly fluid in terms of being unconstrained by the wider group. There's certain things we have to make sure we're not overly exposed to one developer and things like that. But so forgive me, I don't have the detailed answer to your question, but yeah.
Hi, Gary Fisher from Mo Consult. A lot of what I was going to ask has already been asked, but I was going to say, why don't you take it a step further and become like a JV partner, work with us. My experience of banks is you've got to jump through many hurdles in order to get money out because of the risk involved. So I'd sort of spin it back the other way to say, that you always talk about putting some skin in the game from a developer's point of view, so putting money in so that you've got that security. So it'd be like, well, can you put some skin in the game backwards in order to show that true partnership, especially when it comes to more radical developers like ourselves?
Yeah, let's say that's not necessarily a Citra response today, but Housing Growth Partnership do exactly that. So they can put in up to 30 million of equity into a project. Their whole raising debt is to support SMEs do more. So they will put in equity, partner puts in equity, you then go and get debt to fund the scheme. So there's definitely a conversation there with Housing Growth Partnership in terms of how they work.
And it's worth saying that Housing Growth Partnership is a partnership between Lloyds Bank and Homes England. And it is that, it's trying to cover the bridge between the risk and the equity, and your word, scheme. And Arnaud Deblay, a French investment banker who runs that business, I think lives in Bristol, or certainly has connections in Bristol. So we could go and have a conversation with him. And certainly he's come to see our work, and they're really keen to, because basically the reason why it's happened, Homes England stepped in the financial crash of 2008, all the SME builder developers fled the market. And what that left was the larger ones who've become even larger, and then the smaller ones can't come in because the risk lend profile. So the Housing Growth Partnership is specifically set up to rebuild. I think in 2010, 40% of our homes were built by small builder developers. Today it's 8%. So they want to rebuild that base, which gives that ecosystem diversity.
Yeah. Yeah, and they're also interesting. So, I say Housing Growth Partnerships are doing that today. They will look at it and go, use your conventional funding stack. There's a private sale element in there suggesting, and actually that carries its own risk. What we're starting to test is actually if you then put Citra there as the takeout partner, so we wouldn't get involved with the funding, but if we're there as actually that's who's going to be buying the homes on completion, actually again it changes that risk profile of the debt, because actually from Lloyds' perspective, they know Citra's there, and therefore, yeah, they can take that view in terms of actually how they fund it. Again, early days, but yeah, it's potentially there.
Fantastic. Well, thank you so much, Craig.
Pleasure.
It's really brilliant to have you in the room and to hear about all this exciting stuff in a very short period of time as well, and lots more innovation on the horizon.
Absolutely.
By the sounds of it. And maybe we've even got between us the makings of a radical housing finance conference. There seems as if there's enough players in the immediate area for us to pull something like that together. Anyway, thank you very much. Please, thank you.